Yeah, I would say probably treasuries are probably the most prominent example of fast thinking today, whether people are just piling it. It gets to a broader macro question that I'm not smart enough to answer, which is basically what's future economic growth and where interest rates go. So uh, it's not to say that the market is totally wrong. It's just to say that, yeah, I think it would be very helpful for anyone who owns any sort of fixed income instrument, not just treasuries, because with interest rates where they are, as we heard about yesterday, it's gravitational pull on every asset price that's out there, whether it's a car loan or a mortgage loan or the price of an equity in the S&P 500. Everything is being influenced by interest rates today. And so I would say that that's the biggest example of System 1 ruling the day today. And it's not to say that it's wrong per se, it's just to say that that is certainly the automatic autopilot response is interest rates are low, so I'm going to reduce my required return. And that's probably fine for some things, and it's almost certainly a big mistake for others. And I would argue it's almost certainly a big mistake for anyone who's taking a lot of duration right now in fixed income. It's just, there are scenarios where that'll work out just fine, but there are also a lot of scenarios that are very significantly possible, if not likely, where that's going to be a total disaster. And I just don't think that's the kind of investment bet you want to make. Other examples, on the flip side, I think there's a natural tendency for certain investors to sit on too much cash because of uncertainty today. They don't like what's going on in Washington. They don't like economic growth being so sluggish. They don't like unemployment being so high. And so their natural response is a rational one, and they say, okay, well, I'm not going to buy treasuries at a de minimis yield. I'm not going to buy a bond fund at a yield that doesn't do a whole lot for me. And that's a very rational, well thought out response. The problem is then what do you do with your money, right? And so you are in a bit of a catch-22 there, and I think it's helpful to engage a little bit more deliberate process and certainly hold a healthy chunk of liquidity in cash where you're not taking any credit risk and where you have funds available for better opportunities in the future. But again, if you have liabilities and needs that stretch out more than a couple of years, you can't be sitting in 50 or 60 or 70% cash today. It's just you have the opportunity cost of that wasting asset and inflation working against you. So that's a System 1 response where everybody say, well, I don't like this, so I'm just going to do this. Okay, well, your response isn't a whole lot better than the problem you're trying to avoid. So it's a very tricky time. You have to really pick your spots. I don't have any great answers, big panaceas that are out there, unfortunately. But yeah, I would say certainly given what's happened in the last few years and the levels that we're talking about, I mean, just as recently as a few years ago, who would have thought that it was possible that we'd be sitting here talking about the 10-year at 1.65 or wherever it is today? I mean, in that ballpark, and 30-year, 3% or lower. I mean, no one would have given that much chance of happening, even just a few years ago, that we'd still be here at this point talking about that. And it's like, it points to the inherent uncertainty of big macro factors like that, and it's tough. And I definitely would encourage, like I said, anyone who is invested in a lot of fixed dollar securities right now to do a pre-mortem on those, because I think it'll heighten your senses in terms of the risks that you may be overlooking or glossing over right now.